Hi everyone, my name is Gemma Yates. I am the Investor Engagement Lead at ACCR and I'll be hosting the webinar today. I'd like to start by acknowledging the Gadigal people of the Eora Nation, who are the traditional custodians of the land that I am dialing in from today from Sydney. So I'd like to pay my respects to elders both past and present. A few things to note before we do get started. This webinar is being recorded. We will make the slides and the recording available to everyone who has registered for the webinar today. There will be Q&A at the end of the presentation. We have allowed an hour for today's session. So if any questions arise during the webinar, just pop your questions into the Q&A box at the bottom of the screen. Thank you to everyone for joining the ACCR Glencore pre-AGM briefing. Today we'll be presenting our analysis of the 2024 to 2026 Climate Action Transition Plan, which will be put to a vote at the May AGM. This is now the third plan that ACCR has provided a detailed assessment of, and over that time, we have seen escalating investor concerns around the company's exposure to climate risk. On the ACCR panel today, presenting our analysis of the Climate Action Transition Plan, we have Naomi Hogan, Company Strategy and ACCR Glencore Lead, Isaac Pang, Analyst, Pranav Dayal, Analyst, and Sarah Bruin-Elshal, who is a Company Strategist as well. So without further ado, I'll pass over to Naomi to get us started.
Thanks so much, Gemma, and thanks everyone for joining us. As many of you may know, I've been looking at the company from ACCR's perspective over the last 2.5 years. And this year's climate plan is particularly important considering the huge amount of investor engagement that we've seen over particularly the past recent 18 months or so, and particularly in light of the large vote against the climate plan last year. There was a 30% vote against, and there was also a 29% vote in support of a shareholder proposal to see greater disclosure, particularly around the coal business and the CapEx related to coal and Paris alignment. So we've really worked hard to go through and test, has this year's climate plan met the objectives and the demands of investors over the past 12 months. So our key findings, and in short, is that no, this plan doesn't, and it's actually quite disappointing in light of escalating shareholder concern and a lot of engagement. We're actually seeing Glencore walk backwards, even from some of the commitments and statements it was making last year. So to step that out in brief, we are seeing less transparency on the forward thermal coal production volumes and emissions. We're seeing an ongoing and an inflated baseline year. The 2019 baseline year gives the impression that emissions have dropped already by 22% because of that inflated year. We're seeing now that Glencore, which had previously said that its targets coincided with the IEA net zero emissions pathway, has now walked away from that pathway and IEA NZE scenario. It surprisingly is now providing less CapEx guidance on coal than in previous years. In previous years, we at least saw a breakdown between expansionary and sustaining CapEx for coal. Now we're not seeing any difference between those. We're just getting the one number, making it very challenging for investors to ascertain whether or not that CapEx is Paris aligned. And we're also concerningly, particularly in light of a lot of investor feedback and interest in the Teck EVR mines and the emissions associated with that, we've heard from Glencore that they will not combine and provide a consolidated climate plan once that acquisition has been completed, and in fact is saying quite clearly that it will not, and it will treat those entities separate and not bring in to the baseline or decarbonisation targets those EVR mines. Quite concerning at a time when investors need more information, not less, considering the upcoming decision about whether or not to spin out the coal business. So in light of all of that, we feel that it's actually starting to escalate to a governance issue now. We've had 3 years of the company being unresponsive to shareholder feedback, and that persistent unresponsiveness has now demonstrated to us that this has escalated to the responsibility of the chair, Kalidas Madhavpeddi. We note that there have been material walkbacks on recent disclosures. There's decreasing transparency, particularly around the coal business, and there's a failure to address shareholder concerns. As I said, in terms of the upcoming potential for a coal spin-out, now is time when investors need more information about what the transition risks are and to get a full picture of the business. And therefore, we feel that this AGM does offer investors an opportunity to make very clear the expectations for more meaningful disclosures around those risks. And it is certainly our intention to vote against this climate plan and against the chair. In terms of the significance of this plan and why we've focused on Glencore, it's worth noting that this company and its emissions are globally significant. A recent report by Carbon Majors noted that since the Paris Agreement has been signed, in terms of emissions between 2016 and 2022, when we look at publicly listed or investor-owned companies, Glencore rates 7th in the world in terms of the emissions from that company. We've also crunched the numbers in terms of the remaining carbon budget and what Glencore's emissions are likely to consume of that budget, 2.4% based on its current operations forecast. And that could rise to 2.9% of the global carbon budget with planned coal mining expansions by Glencore. Therefore, we note that it's hugely significant and certainly very significant player in those key coal export markets where it operates in Australia and Colombia and South Africa in particular. And therefore, again, we would expect very strong disclosures because of the nature of the scale of this coal business. And finally, from me, and to step it out a little bit more, we can't see from this plan, which we would have expected to see after all the feedback, we can't see whether coal production is increasing or decreasing over the coming years. There's no specific information about those brownfield expansions in particular. And we're noting the Hunter Valley operations. There's a very large project there where there's not information about the scale of production. There's also no emissions estimates for those large expansionary thermal coal mines. And we're certainly not seeing clear information on how Glencore will responsibly wind down its thermal coal production. So in light of the lack of disclosure from Glencore, our research team has done a lot of work to go and look at projecting out what we can see from the coal business. And I'll now pass over to Pranav to go into detail.
Thanks, Naomi, and thanks everyone for joining us today. I'm Pranav, analyst here at ACCR, and I'll just be talking through our analysis of Glencore's latest climate action transition plan. If I were to summarize our key takeaways in one chart, it would be the one you see on your screen here. This is Glencore's coal emissions forecast relative to the IEA's NZE coal pathway for coal emissions, as well as Glencore's emissions reductions targets. This shows two key insights. The first one is that Glencore's emissions forecast for coal is significantly misaligned with the IEA's pathway for coal. And the second key insight this shows is that boosted by an inflated baseline, Glencore reports a 20% reduction by 2020, which really brings into question the validity of its 15% reduction by 2026 target, as well as the ambition of its 25% reduction by 2030 target. The boost given by this misrepresentative baseline also allows Glencore to maintain broadly flat emissions through the 2020s, which is a critical decade of action in order to meet the goals of the Paris Agreement, especially for a commodity such as coal. As Naomi highlighted earlier, Glencore fails to provide clear transparency to investors in terms of what its forward coal production would look like, making it difficult to assess the company's climate alignment as well as the transition risk that it could face. We modelled Glencore's forward coal production based on publicly available data and found that between 2023 and 2030, coal production for Glencore is estimated to increase by 3%. This is in contrast to the IEA NZE scenario, which requires a 42% reduction in coal production in the same time period. The growth in coal production for Glencore is attributed primarily to the HVO continuation project, represented by the light grey colour area in the chart there, as well as the Glendale Continued Operations Project, represented by the light green area on the chart there. Moving on, one of the key parts of a climate transition plan is its base year, against which progress towards emission reduction targets are measured against. If a company chooses a higher than normal, a base year with higher than normal emissions, it has the effect of misrepresenting future emissions that are reported that could be more typical and usual of the company's emissions portfolio as emissions reductions. And this is exactly what's happening in the case of Glencore, where its 2019 base year has emissions that are 30% higher than the average of the subsequent 4 years, as you can see by that chart on the right. Glencore's 2019 baseline year is not in accordance with the Greenhouse Gas Protocol, the SBTi, or the new European Sustainability Reporting Standards. One of the ways in which this baseline has been inflated is that it has been selectively adjusted for significant structural changes within Glencore. And an example of this is when the base year was restated for the acquisition for the Cerrejón mine, but wasn't restated for the disposal and the transfer of ownership at the Prodeco mines by the same token. To explain further, Glencore acquired the Cerrejón mine in 2021 and correctly restated its 2019 baseline. This involved incorporating the acquired stake of emissions from Cerrejón into the 2019 base year emissions, as well as every year onwards. This is in stark contrast to how the management of Prodeco. So Prodeco made up 10% of Glencore's emissions in 2019, which dropped to virtually zero by 2020 and every year following that. And this was due to the suspension of operations in 2020, which ultimately led to the transfer of ownership to the Colombian mining authorities in 2021 and the disposal of that asset. Based on the Greenhouse Gas Protocol, the 10% share of Prodeco should be removed to avoid inflating the base year and misrepresenting the disposal of Prodeco as an emissions reduction. And this is actually something Glencore have promised to do in their 2021 climate report, but has not been followed through on. Sorry to digress, but the overall effect is that an inflated baseline means that the company's targets and transition plan lacks forward-looking ambition. And what I mean by lacking forward-looking ambition is that, as you can see by that chart there, Glencore achieves a 20% reduction in coal emissions by 2020, which is and achieves its 2026 15% reduction target 6 years ahead of time, allowing the company to maintain flat emissions or even increase emissions between 2020 and 2026 and still achieve its target. Somewhat more concerningly, Glencore's new 2030 target, which the company claims to demonstrate its commitment to decarbonisation, only requires a further 4% reduction in emissions from 2023 levels. This is not what responsible coal wind down should look like. One of the most disappointing things from the climate plan was that Glencore has walked away from the IEA's only Paris-aligned scenario, the NZE scenario. I'm going to digress a little here, but I just want to provide some context into how what the scenario has meant for Glencore and what the move in this climate plan means. So previously, Glencore had implied to investors and communicated that its targets were aligned with the IEA's gross NZE pathway, as you can see by the chart on the right there, where Glencore's targets sit on the solid green line, as well as the quotes on the bottom left of the screen, which kind of reinforce that its 2026, 2035, and 2050 targets were in line with this NZE gross pathway. The gross pathway is a pathway that involves all fossil fuels, so coal, oil, gas, as well as bioenergy as well, and also has all forms of CCUS and carbon dioxide removal factored in. Our view for Glencore, whose emissions portfolio for fossil fuels consists over 99% of coal emissions, was to improve on this and commit to a pathway that is more applicable and specific to its portfolio, which is an NZE coal-specific pathway. Glencore had the opportunity to demonstrate its commitments to the Paris goals and take a step forward and strengthen its targets in line with this specific pathway in this climate plan. But instead, Glencore has walked away from the plan entirely and is now dismissing the NZE scenario, the IEA's Paris-aligned scenario, as unrealistic. Something that's also concerning is that Glencore have not provided any other feasible alternative pathway that they are aligning to, making it that much more difficult for investors to assess the progress on its climate commitments and transition risk on a year-on-year basis for Glencore. Our modelling for Glencore's emissions forecasts shows that it is significantly misaligned with the NZE pathway looking forward. As you can see on the chart, it consistently sits above that NZE line, highlighting this misalignment. But more concerningly, until the mid-2030s, it is also misaligned with the APS pathway, which is the IEA's non-Paris aligned 1.7 degree warming by 2100 pathway. And it does drop to below the APS pathway post the 2040s. And this is due to the closure of several large mines, most notably the Cerrejón mine. And so we saw what Glencore's alignment to pathways looks like on a year-on-year basis, but a more accurate way of looking at its alignment to a specific pathway is on a cumulative basis. And by that, I mean its total sum of emissions in a given time period relative to its allowed carbon budget in that time period for that scenario. And so this is Glencore's cumulative alignment to the NZE scenario. And as you can see, it significantly overshoots it by 2050. So the number we want to concentrate on here is where the company ends up in 2050, which demonstrates its cumulative alignment through 2023 to 2050. And Glencore overshoots its pathway by 2.7 billion tonnes by 2050, which is extremely significant. This is, as you can see by the chart, attributed both to existing operations, which aren't NZE aligned either, as well as the major expansion projects, the HVO continuation project represented by the blue area, as well as the Glendale continued operations project represented by the yellow area on the chart there. So yes, Glencore is significantly misaligned with the NZE pathway. We also carried out this analysis for the APS pathway on a cumulative basis and found that, yeah, cumulatively Glencore was also misaligned with the IEA's 1.7 degree pathway as well. And this is driven primarily by the expansion projects it is pursuing in the Hunter Valley, as well as the Glendale expansions project. It overshoots its pathway by 250 million tonnes by 2050. So something that Glencore communicates to investors in its climate plan is that its 2030 target is currently ahead of what the APS requires. And this is somewhat problematic in the company's representation in the climate plan. The APS is a dynamic pathway, as you can see by the chart on the right, with increasing and iterations of the APS, ambition and the rate of decline for coal has increased and is dynamic based on the pledges and announced commitments in the NDCs by countries. And this is a trend expected to continue going forward. Whereas Glencore's targets are likely to be static and unchanging with subsequent increases in ambition and iterations of the APS. And so it's only a matter of time till Glencore's targets also begin to appear less ambitious than the APS, which really brings into question its commitment to the goals of the Paris Agreement. We analysed the 2023 global coal emissions, which weren't incorporated in the latest APS, and found that they were higher than normal, which required a faster rate of decline to meet the goals of the APS, which already puts its 2030 targets, makes its 2030 target less ambitious than the APS scenario. And so this is quite concerning as well. I'll now pass over to Isaac to talk us through the rest of the analysis. Thanks.
Thank you, Pranav. So my name is Isaac Pang, and I'm also an analyst at ACCR. Now shifting our focus to another critical aspect where Glencore's transparency is lacking, its disclosure of coal capex. In 2023, 29% of shareholders supported a proposal urging the company to disclose how its capex allocated to thermal coal production will align with the Paris Agreement. The reason for this ask was so investors could analyze the proportion of expansionary coal capex and assess Glencore's exposure to climate-related risks. Instead of improving disclosures in this area, Glencore has gone backwards. In this new climate plan, Glencore no longer distinguishes between sustaining capex and expansionary capex for its historical and forecast industrial coal investments. There's ambiguity around whether expansionary capex includes brownfield expansion investments. What we are also seeing, as the chart shows, is a substantial increase in coal capex in FY23, and it is forecasted to remain relatively high in the coming years. This raises questions for us. The reason for this increase is unclear, and the increasing coal capex does not seem to correlate with Glencore's commitment to responsibly phase down thermal coal production in line with the goals of the Paris Agreement. We encourage investors to ask the company for more information. This coal capex increase also contradicts Glencore's previous statement in its 2022 climate plan, where it states the overall trend and trajectory is expected to be significantly down over time. Unfortunately, this is not the only instance where Glencore contradicts its commitments. After the 30% vote against last year's climate plan, Glencore was required under the UK Governance Code to consult with shareholders and to formally report back on the views received and actions to be taken. Glencore provided an update on the consultation in December 2023 and acknowledged the integration of the recently acquired 77% stake of Teck's EVR steelmaking coal assets into its climate strategy was a principal area of interest for shareholders and committed to addressing its climate-related aspects. However, in this new climate plan, Glencore states it does not currently plan to include the EVR assets in its climate reporting. Instead, it will report EVR's performance separately, excluding the EVR mines from the group emissions baseline and climate targets from the deal's closure in Q3 2024 to the potential demerger within 24 months thereafter. The EVR met coal mines should be included in Glencore's group climate reporting from the date it completes the acquisition transaction to meet investors' expectations and comply with the greenhouse gas protocol guidance. So the top flow chart shows what Glencore intends to do in relation to disclosing the EVR climate-related information. As I mentioned, following the deal closure in Q3 2024, Glencore intends to report the EVR climate-related information separately and not incorporate it in its group reporting. If shareholders do not approve the demerger, Glencore will only assess how best to integrate the EVR coal mines into its climate transition strategy. So the commitment to integrate this is unclear. The bottom flow chart shows what Glencore should do. EVR climate-related information should be incorporated in its group reporting from the date the acquirers obtains control of the acquired assets, consistent with financial disclosures. This is important for investors to gain a current understanding of the climate-related risks and opportunities associated with the integrated business and make informed decisions when Glencore seeks shareholder approval for the demerger. If shareholders do not approve the demerger, Glencore should continue reporting EVR in its group reporting. So following our discussion on the inclusion of EVR coal mines in Glencore's group climate reporting, it's important to address how Glencore's view on metallurgical coal contradicts current realities and overlooks transition risks. In this new climate plan, Glencore states that steelmaking coal is an important transition-enabling commodity, as it is an essential input into much of the world's steelmaking in its current form. However, when modeling EVR's coal production through to 2050 based on publicly available information, and comparing this against the IEA's coal pathways, ACCR found that EVR's coal production remains high all the way through to 2050. So the dark blue line on this chart, and it's significantly higher than the approximately 90% decline required by the NZE met coal pathway, the green solid line. The trajectory of EVR's coal production is also not aligned with the coal pathways of the 1.7 degree APS announced pledges scenario and the 2.4 degree steps stated policy scenario. Additionally, while Glencore is quick to assert the importance of steelmaking coal in the green transition, ACCR's own research shows the steel sector, traditionally seen as hard to abate, is making significant strides towards becoming a faster abate sector. We also found that there is a strong momentum in demand for green steel, supported by notable investments and advancements in green steel technology. Customers are increasingly willing to pay higher prices for low-emission steel. In the short to medium term, green steel will be commercially produced, and there will be more green potential technology solutions available, including renewable powered electric arc furnaces, green hydrogen produced with renewable energy, and electrolysis using renewable electricity. With increasing investment and growing customer interest in green and low emission steel, a trend expected to continue. Investors at Glencore should be asking whether it is the right time to increase coal capex and pursue new acquisitions like EVR that are forecast not to be in alignment with the Paris Agreement. If you would like to know more about ACCR's growing body of work on the steel sector, you can access the Steel Decarbonization Research Report via the hyperlink in this slide deck. And this slide deck will be provided to you after this webinar. You can also access our steel sector decarbonization website via the hyperlink here or on our website to find out more about the latest progress of the 20 major listed companies, including iron ore miners and steelmakers, in global steel decarbonization. This webpage is being updated regularly to capture the newest developments in the steel industry. Now that we've examined how Glencore's perspective on metallurgical coal diverges from current realities, let's delve into the concerning governance trends identified in Glencore's new climate plan. I'll hand it over to Sarah to guide us through these trends. Thank you.
Thanks so much, Isaac. I'm Sarah Bruin-Elshall. I'm a company strategist with ACCR. I'll just note that we have received some questions in the Q&A box, and thank you for those, and encourage others with questions to pop them in, and we will come to them at the end of the presentation. And so what I'm really trying to do with this part of the presentation is provide a frame for why we're looking at all of this analysis that you've just heard about the climate plan as now achieving the status of a governance concern. And in doing so, we take a bit of a step back and look more broadly at the wider set of ESG-related controversies that have taken place recently, as well as the company's approach to lobbying. And really, when we look at the climate plan as a whole, we see three concerning trends emerge, and Naomi touched on these in her intro. But we see these material walkbacks on very recent disclosures from the company, an overall trend towards decreasing transparency, and a failure to address shareholder concerns that have been articulated clearly and very recently to the company. And so the information that I'm about to share is really what you've just heard, but with a governance frame put over the top of it. And so to start with, in 2022, in terms of examples of these material walkbacks on recent disclosures, in 2022, we saw the company charting its emission reduction targets as being aligned with the IEA's NZE scenario. And with this latest climate plan, we hear this very clear walkback that the targets of the company are not aligned with that scenario. Just to note quickly on this point, so in Australia on Monday, there was a Senate committee inquiry into greenwashing. The corporate affairs lead of Glencore spoke to that Senate inquiry and made the statement that we do not make any claim to be aligned with the Paris Agreement. We support the goals of the Paris Agreement. So I think that is an interesting statement. It gives a bit of context to how perhaps the company would view our characterization of this as a walkback, and we would suggest, or we would question really whether this kind of statement is congruous with investors' expectations around what it means to support the goals of the Paris Agreement. Just another example here of these walkbacks, again, as referenced by Pranav, in 2022, we saw Prodeco being characterized by the company as a structural change, which would trigger rebasing. And now in 2024, Prodeco is being characterized as a mine closure instead, which doesn't trigger rebasing. And as Pranav explained, that has significant implications for them, the choice of baseline and the level of ambition with which Glencore is approaching its climate commitments. And then the last example here is just last year, The company reiterated its commitment to an 150 million tonne per annum production cap, and it really framed that production cap as being a key part of its climate commitments. And in 2024, it's now dropping that production cap and saying that it may only serve to cause confusion. The other thing to note here is that previously this production cap was really set so high as to be virtually useless. And now, just as the company is approaching making a major acquisition of coal assets, and when this production cap may come in handy, it's being dropped, which is quite notable. This second set of concerns in terms of governance trends that we can see emerging when we look at the climate plan as a whole really points to an overall trend away from transparency. And again, we've seen my colleagues present the walk back in presenting CapEx with the distinction between expansionary and sustaining on coal. Now we just see coal CapEx. And also the fact that from 2020 to 2023, the company produced annual climate reports. And now this year they put out a 2024 to 2026 climate report and provide really no guidance as to when we can expect, or when shareholders can expect an additional climate update, which is really notable in, as Pranav mentioned, what is a critical decade for action. And then finally, this third broad theme that we see emerging, which is this failure to address shareholder concerns. Isaac spoke just a moment ago to this, so I won't belabor the point, but I think what's interesting is that just as recently as February this year, when it released its preliminary results, the company noted that the integration of the EVR assets was a principal area of shareholder interest. And so I think it makes this current statement about their intention to incorporate EVR kind of all the more glaring. And I think what's important here when trying to think about characterizing the climate plan as a whole as reaching the level of a governance concern is to look at the broader backdrop of shareholder dissatisfaction with the company on climate, and note that this dissatisfaction has been escalating for a number of years. We've seen increasing no votes against the climate plan, getting up to 30% last year. We've also seen, quite notably, 2 significant no votes against the chair at the last 2 AGMs, and notably during his first 2 years of tenure on the board, so he joined in 2021. We've also seen, as my colleagues noted, this 29% support for a shareholder resolution calling for greater transparency on coal emissions and CapEx. So really, where we think this leaves us is with a deficient climate plan, and I think that the analysis that my colleagues shared points to that. That really impedes investors' informed decision-making at a time when the company is at a critical juncture, leaves some fundamental questions unanswered, fundamental questions like forward coal production plans, and we consider raises some serious questions about the board's ability to successfully navigate the energy transition, which we would suggest in some points to a governance failure attributable to the board as led by the chair. To widen the aperture further still, and to just briefly touch on the broader set of controversies reported and established against the company. And I mean, what you're looking at here is really a list of a number of human rights violations, water contamination, civil proceedings, related to or stemming from fraud convictions. You know, it's a laundry list of concerns, but really what we want to emphasize here is that while there is a broader narrative that these are legacy issues that the company has now resolved, has made leadership changes in response to, and is now moving on from, you know, what you can see in these bolded parts of the slide is that a number of these concerns are ongoing or have been unfolding kind of in the 2022, 23, and up to this year time period. And they have been occurring really since the appointment of the chair in 2021. So these are a recent set of concerns, obviously, in addition to a longer legacy of ESG violations that have been widely reported. And I think when we take this wider lens, what we can see is that there are broader governance weaknesses that can raise legitimate questions about the company's ability to manage the climate transition. And, you know, the way we are thinking about this is that if these ESG controversies and the consequences that stem from them are continuing to pervade despite many years now of adverse coverage from financial analysts, from the media, from NGOs, years of regulatory scrutiny, culminating in public criminal prosecutions, as well as private legal actions. You know, if these things are allowed to continue despite a change in chair, we might ask the reasonable question as to whether the board is really willing and able to direct meaningful change at the operational level to help ensure that these risks are being properly addressed. And I think here it's relevant to note that earlier this month, Sustainalytics chose to maintain its governance red flag against the company and highlighted gaps between management practices at the group level and their implementation at subsidiaries, particularly in sites of high risk. So, you know, we think this begs the question as to whether there are then fundamental governance weaknesses that are also serving to undermine meaningful improvement on climate transition risk management, and whether this is a company that as a whole is resistant to systemic change and that requires really years of prolonged and escalating pressure from a broad range of stakeholders in order to firstly acknowledge the existence of a problem and then to begin to try and address that problem. So changing gears just slightly before I hand back to Naomi, it's important also when we're talking about governance at Glencore to look at its track record on in terms of lobbying. And here what you can see on the right-hand side of this slide is a chart that shows that Glencore's lobbying is misaligned with the goals of the Paris Agreement, and it has been ever since these assessments began, and it's also performing worse than 80% of C100 plus companies in terms of climate lobbying. So not only is Glencore really substantially misaligned in terms of its approach to lobbying with the Paris Agreement, it really fails to recognise this misalignment as being a governance issue. It falls short of best practice guidance. Its review process does not take into account really material forms of lobbying. For instance, it doesn't provide any transparency over its lobbying activities in Asia and the Americas, where it derives 63% of its revenue from last year. It also doesn't review more than 2/3 of industry associations of which it's a member and to which it pays $100,000 US or more annually as member in membership fees. And so because of this failure to recognise negative climate lobbying misalignment as a governance issue, there is no demonstrated commitment at the board level to address this misalignment. Just finally, I want to touch on the another way in which Glencore exerts influence over government's climate-related policy is to flag that Glencore is a repeat user of investor-state dispute settlement, or ISDS, which is a form of legal dispute settlement whereby companies can bypass domestic courts and sue states directly. And ISDS has been flagged by the IPCC as increasing the risk of regulatory chill, whereby governments refrain from or delay adopting mitigation policies like phasing out fossil fuels. So Glencore has brought 5 known ISDS claims against governments, 4 of which are against the Colombian government, 1 against the Bolivian government. It provides really no insight to investors as to why and when it chooses to use this form of dispute settlement, and also how much spending it allocates to this form of dispute settlement, which is known to be extremely expensive as compared to domestic court systems. So with that, I'll thank you for listening, and I will hand back to Naomi.
Thank you so much, Sarah. Look, I don't want to dwell too much on this. We've heard some very detailed analysis there. I really want to talk to so what now. I know that investors are meeting with Glencore in the lead up to the AGM, and obviously everyone is having to make decisions on votes at the moment. Certainly, we would suggest to really look carefully at some of the requests that were made of the company in the recent year. I've listed there some opportunities to consider, are we seeing coal asset production and forward emissions clearly disclosed and aligned with the Paris Agreement? Are we getting enough information when it comes to CapEx and transition risk? And really, what information do we need to see around the EVR acquisition and the emissions there? Certainly in terms of governance, Sarah has laid it out really clearly, but we obviously want to elevate this issue to the board as a governance failing because of the persistent unresponsiveness of the company to some really clear feedback on the sorts of disclosures that were requested. We want to note that Peter Coates is retiring at this coming AGM, and there will be a new appointment for the head of the HCEC committee, which does play a large role in terms of the climate plan. And that could offer another opportunity for investors to really talk to the company about the expectations around improvement there and around better disclosures of climate-related risk. And certainly we would note that if any investors are considering voting against the climate plan, that it is always worth considering amplifying your position with a pre-declaration, as many investors did last year. So with that, I'll pass back to Gemma and we can jump into questions. Thank you.
Thank you, Naomi. So we have a few questions coming through in the chat box, but if you have any more, please pop them in now. Lewis, thank you for your question. This is probably one for you, Pranav. Are the pathways shown here? So I think that was your first slide, Pranav. Are the pathways shown an amalgamation of the thermal amalgamation of thermal and met coal? And if so, surely the situation is even worse because there will arguably be a higher role for met coal in a net zero world than thermal coal. And I believe Glencore only produces thermal coal.
Yeah, definitely. I'll answer that in a few different segments. Firstly, the emissions portfolio is pathways based directly off the IEA's coal emissions numbers in the extended data sets for the World Energy Outlook. But for the production pathways, we have broken that down by thermal and met coal and have adjusted and indexed that for Glencore's share of thermal and met coal production. So Glencore's current met coal productions come predominantly within Australia from mines such as the Hale Creek, Oakey North or Collinsville, as well as increasingly we expect it to come from Canada with the acquisition of Teck's EVR, 77% of Teck's EVR mines. But our model is capable of distinguishing between met and thermal coal. So if you're looking for specific insights by specific thermal or met coal, please feel free to reach out. And yes, it is true that met coal has a slower rate of decline than thermal coal in the IEA's NZE pathway, but ultimately, as Isaac's slide showed, it is still a relatively fast decline in the IEA's NZE pathway. Hopefully that answers it.
And Lewis, if it doesn't, please reach out and we can provide more information. Thanks for the detailed presentation. Has there been any response solicited from Glencore on any of these points?
Not to ACCR directly, but we do know that Glencore is meeting with a number of other investors, including investors that co-filed the shareholder proposal last year. So perhaps we will hear some sort of indirect feedback that way, but yes, ACCR has requested meetings many times with Glencore over the years, and we've had one meeting as part of a co-engagement group around the shareholder proposal in the lead up to last AGM, but we haven't had engagement around this research yet.
And that's not for lack of trying. I guess this is quite a big one. Any insights on the potential unintended consequences of voting against Glencore at the upcoming AGM? For example, negative impact on financial returns and delisting from the UK to reduce exposure to shareholder pressures.
Yeah, look, it's a really big question, and I don't. I still think it's important to vote in line with one's policy if it requires proper disclosures around major climate transition risks, if there are large emissions, if there has been a lack of useful feedback and engagement at a governance level, then we need to consider that. And we also know, and it was reported again in the financial press today, that there are certainly seen to be major shareholders in Glencore that are not happy with the proposed coal spin out and the delisting and the change to the New York Stock Exchange. So all of that is very uncertain. I think that what is certain is that this company will stay in its current state for at least the next 2 years. And that means that this is an incredibly important time for investors to make clear what those expectations are, and also to encourage where those improvements can be made. I definitely understand and have considered the unintended consequences. However, we're not just hearing this from Glencore, we're now seeing it from Shell, from other companies. I don't think that because companies make these threats that investors shouldn't act on their own investment principles and seek the disclosures they need to ensure that their own investments are in line with their commitments to their clients and to their long-term investments and their risk profile. So yeah, it's a tough position, but we think that we need to keep using this time to have the conversations that are so important with this company.
Thank you. Pranav, this is probably one for you. One final question in the chat. What would have to change with the Prodeco contracts that were handed back to the Colombian government for Glencore to meet the greenhouse gas protocol standards? The mines have not produced anything for the past 2 years, and the Colombian government hasn't got any interest in operators at the moment.
Yeah, definitely. I think the way in which that's a really good question, and why we consider the Prodeco mine as a transfer of ownership is based on a few different reasons. One of the key reasons is that it's in operating condition at the moment, and Glencore has not conducted the appropriate rehabilitation required for it to be a mine closure and for it not to be in operating condition as well. Another thing is that the Colombian government is still looking for potential operators, and I think they are set to get control over the mines in July 2024, pending some environmental regulations. So we might see some action after that. But kind of bringing it back to Glencore, I think in the global reporting standards for emissions, it's quite clear that emissions reductions due to reduced capacity in operations should not be classified as an emissions reductions. And just going back to that, we think that Glencore should account for the disposal and the transfer of ownership at Prodeco in the right way and remove it from its base year, or select an alternative base year that does not have that making up 10% of the emissions share. So yeah, in our eyes, I think those would be the two key steps to deal with Prodeco in the right way and in accordance with the GRI and the Greenhouse Gas Protocol.
Okay, thank you, everyone. We are almost at time. Thank you for dialing in to the briefing. If you have any follow-up questions, don't hesitate to reach out to any of your ACCR contacts. And yeah, happy proxy season. Good luck. And we will hopefully be back in touch next year. Thanks, everyone. Have a great day.